If you recall last night, I mentioned that we were near a intermediate term high here, and I want to kind of teach that tonight as to what led me to believe that it was going to do this today. So we had this nice volume imbalance I mentioned when we were trading back here and traded down to that, made the low, rejected off of that, and then it started going parabolic, going straight up, covering a lot of ground. And one of the, I guess, the easiest way to describe it is when it's breaking out to all new all-time highs, and it's doing it in a lot of strength, leaving inefficiencies open, not coming back down into the volume imbalance here. It just keeps powering higher. And if it feels like if you were a brand new trader, you would just chase that going long anywhere during the day, that's usually indicative of when a blow off type move or a intermediate term high is likely to form, because the public's seeing this. Okay, when street money sees these types of tearing higher in price, they just want to accumulate whatever long position they can and just hold on to it and think they can make a lot of money off of it. So we're going to take a look at the 1 minute chart because that's where the intermediate term high is going to form. Okay, we're using the daily chart for bias and direction and key sensitive levels, but the structure is inside of the intraday chart. And since I'm taking you into the 1 minute chart on NQ all the time, we're going to be looking at this overall market structure here. Quadrant levels on this premium wick. And now just showing the upper quadrant and the consequent encroachment of this premium wick. You can see that being showcased down here. So we have sell side liquidity relative equal lows. And as I mentioned last night, intermediate term high. So if it's going to be an intermediate term high, what could it likely draw down into? Well, that premium wick here. Okay, now classic support and resistance would say, just take that old high, draw that out in time. And when it trades down there, it should bounce. It didn't do that, did it? So we want to look inside these inefficiencies because they're just like gaps. And by having the upper quadrant and consequent encroachment, which defines whether or not this is going to be a continuation of a deeper retracement, or if it's just coming back down in here to consolidate and send it even higher. So we're going to take a look at a question that you might have. So where is the intermediate term high? There's your intermediate term high. Okay. And that same high is here. So we have a high, a lower high, and a lower high. And it has a smaller little high here, and here, and here, and here. So we had high, low, lower, low, and that high there. So these are short-term highs, intermediate term high. Intermediate term high is any high that has two lower short-term highs to the right and left of it. We also have it in a smaller scale here because it's fractal. But now when this price leg starts to break lower and takes out these relative equal lows, when I'm looking for an intermediate term high, as I indicated I was last night, this is a shift in market structure. So the market goes up into this consolidation right before the 9:30 opening. So it creates this like real smooth edge. And it's tricky because you might expect it to run up there and wipe out the buy side and then break lower. You have to wait. You have to wait for it to just tear off and go lower. So we're going to look at all this price action in here. I'll zoom in. Here's that intermediate term high, and here's those relative equal highs. And look how the market was just stabbing up air. Very volatile, just punching up air, punching up air, punching up air, and then ripping lower, tearing off into that sell side liquidity pool there, and then creating the first presenter fair value gap, which we'll look at in a moment. We're going to scroll forward in time. So here's those relative equal highs, and the market breaks lower, creates a little bit of an imbalance in here. Now, you might look at this small little gap right there and call that your first presenter fair value gap. And if you did, there's nothing wrong with that, okay? But I like to use the more pronounced, the obvious displacement one here, okay? So while I'm showing you this, don't be discouraged if you see this small little section, because I told you it can be one tick, but I'm going to be more likely to pick a inefficiency that's much more protracted. In other words, it's done more of a displacement. In my direction being lower, I want to see it be, very strong like it's shown here. So this is how I'd classify my first percent of fair value gap today. The market breaks lower after touching into it here. Body's respecting it. Creates relative equal highs. Market trades down here. Consolidates. Digs right back up into that first percent of fair value gap. And the buy side's taken here. Breaks one more time. Leaves these relative equal highs. Comes right back up into first percent of fair value gap. And breaks lower. And then breaks below this low as well. And we're going to see going forward now, we're going to jump a little bit more in the future of the day in the chart now after the sell side is annotated. So now we can have our reference point here. So those two lows rather. So I was showcasing. And the market breaks lower, comes back up into another reclaimed fair value gap there. And the market creates relative equal lows again, trades right back up into the reclaimed fair value gap, breaks below relative equal lows and the old sell side liquidity pool, and trades up into a bearish fair value gap. Breaks lower, consecutive up close candles is your bearish order block, and changes daily delivery at that candle's open. It accumulates more shorts by smart money, breaks lower. Again, bearish order block, change in daily delivery. Smart money would accumulate new shorts in there, adding. Same thing on this up close candle. Bearish order block, change in daily delivery, trades up into it there. Smart money would be accumulating more shorts, pyramiding, adding, breaking lower. Then we have a fair value gap here. It's bearish. Trade up into it. And there's all this to wicks. Just very, very heavy as it's reaching for the upper quadrant of this premium wick. The check mark here is indicating it touches down on the daily objective of that upper quadrant. You can see that happening here as well. After that, we have a little bit of a bounce up into this inefficiency that I did not note. And showing more data, we just hammered it one more time. But I mean, look at this. This is what you expect to see when you read books about classic support and resistance. This is not classic support and resistance. Okay, when they're used in concert with what everything else I've taught, it really gives you an X-ray view of what price is likely to rebound off of or draw to. And you can see this, the beautiful respect over here with the bodies. The bodies here, yes, you had errant wick action in here, but the bodies are accumulating around that same quadrant level. And finally just pulling back off the lows of the day.